Give us a sense of the equities, because we started the week really at record levels, and then the inflation numbers hit, but then they came back up at the end of the week.
Yes, they did. The inflation genie seems to be out of the bottle, and markets have to digest that. The technology stocks, many of them seem to have such significant market shares or competitive positioning. The market is giving them credit for being able to price this inflation, pass it on to consumers. But there are many in both industries and sectors, according to our team, where that won't necessarily be the case. And that's really the job of the fundamental research analyst, is to determine whether or not a business, say it's consumer staples and food beverage, can they pass on their increased cost of raw materials on into their final product? Because if they can't, that means margin squeeze, and that means earnings will, all other things being equal, will decline, which is not good for markets.
So, Greg, when we see inflation numbers like this, we automatically think about what it does to bonds, and perhaps most important, what it says to the Fed and how they might react. What did you make of this week?
Yeah, I think that's the story. What it makes, what it tells you about the Fed and central bank action ultimately. And so there's been this response in the bond market really before the CPI print that inflation is picking up, and more importantly, that the Fed is going to be much more aggressive, and central banks globally much more aggressive than initially anticipated. So I think that is the story in the marketplace, the two-year yield. And then equally, I mean, this is a volatile market in fixed income that has been largely isolated in fixed income. So what you're seeing is this disconnect in volatility in fixed income and equities. And yes, it does make some sense for sure, as the earnings coming out are quite strong, margins all-time high. The micro story is quite supportive. But at some point, the volatility that we're seeing in fixed income markets have to start to infiltrate other markets and risk markets if it doesn't settle down.
But Craig, at the same time, how much is the Fed sort of putting a blanket on that volatility, even given what we've seen? Because certainly they've made it pretty clear they're not in a rush to change course. You just heard Mary Daly say, well, we're not going to change course right away.
Yeah, but they've changed their rhetoric quite substantially since the summer. And if you look at the bond market yield into 2-year and even inflation, it's been commensurate with the change in Fed tone. So I don't know. I'm really worrying about the Fed here moving too fast, too soon, particularly when you think about the construct of inflation, that it's largely outside of the Fed control. So the Fed raising rates isn't going to help offset the supply chain issues, right? It's not going to have those kind of effects like it normally does.
That's a really important point. No matter what the interest rates are, it's not going to help the supply chain right now. Sarah, what about over on the equity side? If you're looking at equities, are you more concerned about what the Fed might do in terms of interest rates? Are you more concerned with what you were talking about, which is really pressure on margins just because prices are going so high?
We're concerned about both. Our team at Causeway are looking at both what could affect earnings and also to what degree, if the Fed does react prematurely, is that going to be a depressant on markets overall? We just think about market sensitivity or beta and which stocks have it and which don't, and how to be positioned in this kind of environment. But the cry we hear from companies, and we interview hundreds of companies, is that they don't have the labor they need. There seems to be this chronic labor shortage, which is something we haven't seen. Normally we talk about slack, and that doesn't appear to be the case. And it's not like the labor isn't there somewhere. It doesn't seem to want to work in many of these jobs. And that ultimately may lead to a solution in automation or types of labor replacement. But in the interim, that means that the wage has to rise in order to attract the labor that's needed to make, for example, packaging. And how high does it have to go? And then once it's there, is it intractable or likely? I mean, people don't very easily accept wage cuts. They only want increases. And if it ratchets upward, that, in our view, is a wage price spiral. And the Fed should react.
Yeah, that is the concern, that wages tend to be stickier than other sorts of prices, no question about it. At the same time, if in the short to medium term they have to raise wages, it puts pressure on margins. Sarah, how do you differentiate who can raise their prices and who can't? You talked earlier about pricing power. Is that by categories or is that company by company, depending on their brands?
It's both. But thinking about, let's stay within technology because it's been such a hot area of all markets. Looking where there are few competitors, an area that we like now are semiconductors, particularly memory, and there are really only three: Micron, Samsung, and Hynix. The latter two are in South Korea. They have such significant scale advantages over all their competitors that there have to be a shortage of their product, but to the degree they have price pressures themselves, they should be able to pass those on because there are no alternatives. And where there aren't alternatives, there is some flexibility, but that only goes so far. There's something called the substitution effect that happens when prices rise for, and maybe not for the essential semiconductor, but other goods that are used in manufacturing. There may be substitution, which could be quite damaging. So really the question is, how long will this go on? Because that's the determinant of what the outcome is for companies.
So, Greg, Sarah says on the equity side, maybe some areas like semiconductors on the tech side might be good investments. What about on the bond side? You're investing in bonds right now. How do you invest? It sounds like you fear the policy error of moving too fast in terms of raising rates rather than too slowly. So what does that say to you as a bond investor?
Yeah, so I think one of the worst areas to invest in the bond market right now is in the inflation market. I think what's being priced in inflation and tips is just too much, to be brutally frank. So that is one area that I would not look to invest. We still see value in U.S. treasuries, actually. I know it's crazy to say, but we think the long-term interest rate from where we are today is lower, not higher. And there's a multitude of reasons for that, in part because there's too much debt in the world. And the inflation story and growth story gets pulled down by that tremendous amount of debt. But within credit, we still see value. So I still see value in the high yield market. It's clearly not what it used to be, that's for sure. But I still think that you're in this environment with strong M&A, strong earnings, that really benefits the high yield bond market. So those are just some ideas, but we still see value in fixed income and we still see value in credit.
So give us a sense of duration, whether it is treasuries or whether it is credit. Where do you see the greater opportunities, particularly given your concerns about volatility in the bond market?
Yeah, so I mean, we always bifurcate the risk, the duration and the spread risk separately. But we're not scared of duration, right? I think the back end of the curve in treasuries has some real value. And then, quite frankly, the front end in credit has a tremendous amount of value. It's risk remote. We think it has really positive attributes. So we see kind of value across the curve. But our bottom line message at PGIM Fixed Income is we do not fear duration, for sure. We think it's an important part of any asset allocation decision.